Good afternoon, everybody. I'm just going to give you a 30-second overview of Ergomed for those that aren't familiar with the company before handing to Miro to talk about our results for last year. So Ergomed is somewhat unusual in the UK market. We operate what we call a hybrid business model, hence two parts to the model. On the one hand, we have a very fast-growing, profitable, EBITDA positive and cash generative services business. We provide outsourced services to the pharmaceutical industry. Within that, there are two types of services. One is the contract of clinical trials on behalf of large pharma, medium pharma. And secondly, we also provide what's called pharmacovigilance services. These are the monitoring of post-marketed drugs for safety signals. And this is, as you can imagine, a long cycle business. So on the other side of the house, what we call is our products division. And again, that is in two parts. On the one hand, my two colleagues here have developed a very innovative model for developing drugs for third parties, and in return for a discounted clinical research fee, we receive a carried interest in those products. So over time, the company has built up a very nice portfolio of products in which we have carried interest. So you can see that we've found a way to expose our investors to the upside that comes from pharmaceutical development without sustaining the downside risk of a complete failure. The second part of the products business is in hemostatics, a company we acquired in the middle of last year, where we own 100% of the products. And of course, should these come to market, this will provide very substantial upside for the company. But I won't say any more about that because Andrew is going to talk to you about that. So at this point, I would like to pass over to Miro to talk about our 2016 results. Miro.
Thank you very much, Stephen. Good afternoon, everybody. Thank you for coming for webinar. On this slide, you can see some of our key financial performance numbers. As you can see, the revenue is up 30% from 2015, reaching close to £40 million. Gross profit is 43% up to £12 million, and our adjusted EBITDA before R&D, which means basically expenses we had on hemostatics products development, is 4.1 million, and after hemostatics R&D is 3 million. I would like just to remind you that analyst consensus of after R&D EBITDA was in the range of 2.2 million pounds, so we significantly exceeded these expectations, reaching 3 million. Moving to the next slide. Here you can see distribution of our services growth. As you can see, we have two kinds of services, what Stephen introduced initially. In the blue part of the pie chart is presented our clinical research service business, or CRO, which has been growing very nicely, 18% last year. This is very mature business with 20 years of history basically this year. And in the red part of the business is phenomenally growing drug safety and medical information business, who grew last year 63%. And out of this 63%, 57% are organic, and the additional is through acquisition which happened end of the year of company called Farm Event. So as you can see, both businesses really doing great, and in fact the pharmacovigilance part of the business is going to take a bigger and bigger part of this pie chart, where we believe that it would come close to half of our revenue in this year. So moving to the next slide, operational highlights for last year have been new business won increased to 50% to 42 million pounds, and contracted backlog also grew to about 70 million pounds. We also did institutional placing of 9.2 million pounds in May last year. We used these proceeds for hemostatics acquisition and also for 3 services acquisitions, what I'm going to explain you on next slides. We also opened our Prime Vigilance Pharmacovigilance US office in Boston, US, and our product pipeline have been enhanced through acquisition of hemostatics and Asarina deal. On next slide, we just wanted to present you our first services acquisition last year, which happened in June. These are two German companies, basically with joint ownership, who have been doing statistics, biostatistics and data management in clinical research for about 25 years. Huge track record, fantastic expertise, as well as internally developed electronic data capture solution called OpiVerdi. These are electronic platforms where the clinical data during clinical trials are captured. So with this acquisition, we basically succeeded to further develop center of excellence of data management statistics, which is very important part of any clinical research activities. We successfully merged these two companies in company which we call now Ergomed CDS, or Center for Data Management and Statistics. Company is Cologne. We've seen very good moves business-wise in winning some full service business after this acquisition for Ergomed Group. We also seen that this specific statistic data management business has been able to win dedicated only data management statistics studies. So basically, we are very happy with the development of this acquisition and integration in Ergomed Group. On the next slide, few information about PharmEvent. This is a pharmacovigilance company which is now merged with PrimeVigilance. The total consideration of this transaction was in the range of 8 million euros. We paid 4.8 million at closure. Out of that, 3.8 million in cash, 1 million in shares. And there are three milestones of earnout, and we are very pleased to announce that the company reached the EBITDA target for 2016 and will get the first earnout in the range of 0.7 million. We are very confident that company would also reach milestones in 17 and 18, which would make this acquisition very accretive for Ergomed. The PharmEvent is founded by two experts in area of pharmacovigilance and regulatory. Both of them have been working for EMEA and started to develop this business somewhere in 2010. They developed extensive network of international PV experts, which complements very well with PrimeVigilance network. And through merging these companies, we broaden international client base and also succeeded to realize some cross-selling opportunities and which will be developed further, obviously. The company has about 60 employees in Prague, Czech Republic, and according to business plan, this will grow over the next couple of years toward 100 employees, and it will augment pharmacovigilance and PrimeVigilance growth. Andrew?
Thank you, Miro. So as many of you know, we bought a company called Hemostatics at the middle of last year, with which we acquired a platform and two products which are used for excessive bleeding during surgery. The lead product is just starting phase 2. The second product is in preclinical development, and then the pipeline is at discovery stage. We show you the deal terms at the first half of the slide, but we've already discussed those last year, and I'll just provide you a little bit of an update on the programs. So since we closed the transaction, we have completed the manufacturing of the material that will be used for phase 2. We've collected and written up the data and all the information needed to gain regulatory approval, and we've submitted that to a variety of governments across Europe, and we've gained the first regulatory approvals for the study, as well as identifying more than 30 sites to take part in the phase 2 study across 7 countries. We announced last week the study is now up and running and ready to go, and we expect the first few patients to be recruited in the next couple of weeks. In addition to that, we continue to have a number of partnering discussions with potential licensees to keep them interested in the product so that when we get the phase 2 data, we can pick up these conversations. But some of these conversations are ongoing at the moment, and we'll explore those and take the different options for partnering as they present themselves. The follow-on molecule, ReadyFlow, is in preclinical development. We're finalizing the formulation, and we plan to bring that into pharmacology and toxicology studies in the second half of this year. and then hopefully take it into phase 1 in the first half of 2018. So those were our 2 wholly owned products. We also have a number of shared risk relationships where, as Stephen said at the beginning, we discount the cost of our clinical trials in exchange for some upside in the product. And I'll just provide you an update with our current partnerships at the moment. With Ferrer, we were developing a new sleeping tablet, and we were very pleased to announce about 6 weeks ago that that phase 2 study read out positively. We were able to hit successfully both primary endpoints, but also a number of the secondary endpoints. So the very positive result for the study and very encouraging for the product's future. Ferrer are now in the process of analyzing all the data generated during that study, discussing it with a variety of key opinion leaders, and will then, once they've consolidated their opinion about the study, they will then initiate a partnering process. Now, as you know, the product is already partnered for Asian exploitation, but Ferrer would like to find a US marketing partner at this moment in time to help them both in ultimately the marketing of the product, but also in the phase 3 development. So the way our deal works with Ferrer is we get a share of all revenue generated from the commercialization of the product. So if and when they enter into a US partnership, if they get an upfront milestone, which we expect they will get a share of that milestone. Ultimately, when the product is being sold in Europe by them or through their partners, we will get a portion of those sales. Aeternus and Antares are developing a new chemotherapy agent for endometrial cancer. We completed their pivotal phase 3 study for this program and announced in January that the study has completed. So we're in the process now of collecting all the data, finalizing the database, and we expect that Aeternus and Antares will analyze and release the results during the month of April. As this product was being developed under an SPA, which means that they had previous discussions with the FDA about the protocol design, we expect the next step for this product, if the program is successful, will be a licensing application in the US and more widely Europe and globally. If, again, like the Ferrer relationship, if Aeternus and Antares enter into other partnering deals and get upfront payments or royalties, we will get a share of those. If Aeternus and Antares take the product to market themselves in the US or other territories, we will get a share of the revenues they generate. And as we've announced over the year, Aeternus and Antares have already entered into a number of marketing partnerships in Asia and Australia and New Zealand, from which they received an upfront milestone, and we have received a portion of that already. The two programs with Cellsci with their multi-kind product. I'm sure many of you have read some of the press releases that Cellsci have been putting out over the last 3-4 months. Whilst the study has actually completed its initial recruitment target, Cellsci decided to have a dialogue with the FDA to increase the sample size. The initial recruitment target was 880, and Cellsci wished to increase that to about 1,280. The reason is that they've seen an overall lower death rate in the study so far, and that means the study will take longer to reach its endpoint. So Cellsci wished to increase the patient numbers to shorten the overall length of the study. Having submitted this amendment to the FDA have then entered into a dialogue with Cellsci about the statistical analysis and the various assumptions that this protocol amendment contemplates. And until the discussions between Cellsci and the FDA have resolved, the FDA have put the study on hold for further recruitment. So what that means is all the patients in the study so far continue to be followed up as per protocol until the FDA and Cellsci complete their discussions, upon which they'll either reopen the study to further recruitment, or Cellsci will take a view of what to do with the study if the discussions with the FDA continue. We also have 2 deals with spin-outs from the Karolinska Institute in Sweden. The first here is Modus Therapeutics. This study is ongoing. It successfully went through its first interim analysis at 25 patients, and because the product was seen to be safe at this point in time, there were 2 sequelae from that analysis. Firstly, Modus decided to finalize the patient recruitment numbers. They had the ability to adjust the final sample size of the study depending on the interim analyses. So they've now settled on the recruitment target of 150 patients. So we now know when this study will finish. And we forecast we should hit that recruitment target by the end of the year, or hopefully by the end of the first quarter of 2018. The second sequelae from that interim analysis is that we are now able to recruit adolescent patients as well as adults, and so we're expecting to see an increase in the recruitment speed because we have a wider population to recruit from. And then finally, with Asarina Pharma, our latest co-development deal, we're in the process of writing the protocol and identifying sites. The company is in the process of manufacturing the product, and we hope to get that back into clinical studies towards the end of this year. Thank you.
Thanks, Andrew. This is Stephen Stamp again. I'll just finish off by pulling out one or two highlights from the P&L account from 2016 and the balance sheet at year end. Starting with revenue, Miro's already given you a breakdown of the revenue and the 30% growth. If you were to strip out the acquisitions, growth was 27% on an organic basis, so still very healthy. Gross profit increased 300 basis points from 28% to 31% in 2016. That was driven principally by two factors. One, obviously, Prime Vigilance became a larger part of the business, which has a higher gross margin in the 47% range. And secondly, co-development came a lesser percentage of the CRO part of the business, reducing from 52 to 40% in the year, and hence higher margin. If you to add back the co-development discount, the gross margin for our CRO would be about 32%, which is more in line with industry standards. I'll now move on to administrative expenses. These are broken out in the box in the middle of slide 11. There are a few things to note. In terms of other administrative expenses, we inherited an additional £1.2 million from acquisitions made during the year. £0.07 million was allocated to improvements in general corporate infrastructure, which frankly allowed us to get many of the corporate milestones done that we did in 2016. And then lastly, there is a £0.9 million provision for doubtful debts. One of our customers is paying us rather slowly at the moment. We're working with them. We think they'll get through their financial issues, but to be prudent, we've reserved £0.9 million. Also included in the box is deferred consideration payable to PharmInvent of about £690,000. Because the deferred consideration was linked to the continued employment of the founders, who are very key to that business, so we must recognize the deferred consideration in the P&L account per GAAP. And then lastly, the thing I'd like to point out to you is although the company has zero debt, we have a very large finance charge of the order of £270,000. That arises from the unwinding of the time discount that is applied to the hemostatics deferred consideration. It is a non-cash item, but nevertheless, GAAP requires us to record it. Moving on now to the balance sheet. Three big movers here. The first of which was goodwill, as you might expect from the 4 acquisitions we made. 2.2 from hemostatics, 0.5 from O&P, and 2.2 from PharmInvent. And then secondly, intangibles. We have 13.1 million addition as a result of hemostatics related to the Peprostat product, 2.1 from Rediflow, OP Verdi, customer lists, and then lastly 0.7 million we invested in RSG software, state-of-the-art software to support our pharmacovigilance businesses. The third item I'd like to draw your attention to is trade and other receivables. And I break this out for you here on slide 13. Trade receivables jumped from 6.4 to 9.5 million, but you might expect that with increased trading levels. If you look at the slide, DSO, that's days sales outstanding, excluding acquisitions, increased 4 days. Not quite in the right direction, but not a disaster either. And I should tell you that by the 23rd of March, we'd collected 90% in cash of the trade receivable outstanding. Looking forward now to news flow over the next 24 months. 2017 is going to be a very exciting year for us in terms of clinical data points, 2 of which Andrew's already referenced and are already been recorded. We have the Eternus Antares phase 3 pivotal data coming up next month, the initiation of the Asarina trial, and the full recruitment of the Peprostat phase 2 trial, all happening this year. Next year, another 4 clinical data points, so lots of value inflection points for our investors coming up soon. Andrew and his team continue to work on looking for more co-development deals. We're targeting 2 a year. Obviously, we're only going to do the right deal. And we're also working on more services acquisitions. PharmInvent deal in particular was very well received by our investors, as expected. We have other pharmacovigilance deals we're working on, and also some strategically significant deals in the CRO space too. I wouldn't expect to see anything before around the middle of the year, but watch this space. And then we've already referenced, I think, Pepperstat, ReadyFlow licensing opportunities. And for those of you who've seen our presentation before, you'll be familiar with this slide. This is our little infographic, which is designed to illustrate our business model. So what we're saying here is the light blue space at the bottom of this chart represents our solid, steady, cash generative, 30% per annum growth services business. If you were to extrapolate that over a period of 5 years, that alone would treble the value of our company. That is the bedrock of the company and underpins our valuation. The blue segments represent the opportunities that may or may not come out of the co-development pipeline and or hemostatics. There are going to be barren years and there are going to be good years. That's the way drug development works. The good news is we have the bedrock underpinning of services. And if you look on the right hand side, that tall bar might represent a hemostatics milestone. And with that, I'll hand back. Thank you.
Great, thank you, gentlemen. Right, we have a number of questions. I encourage people to put them through if they have any more. Firstly, perhaps for you, Miro, Philippa is curious in the CRO universe. Could you elaborate in a bit more detail about why your growth is so much higher than that of the general market? Is it down to your own strengths and reputation or the weakness of competitors? And then secondly, given that you're have a unique model involving co-development, do you know if other CRO businesses are starting to look at co-development?
Thank you. Our service growth, which includes CRO as well as pharmacovigilance services, is growing, as you've seen, 27% last year. Obviously, the main driver of this fantastic growth is pharmacovigilance business, which is growing since 2011 more than 40% per year. Last 2 years growing more than 50%. Coming to CRO clinical research services, obviously the competition is really fierce in that business, and we have certain differentiators which are really unique, especially at European market. We developed over the last 15 years specific model of supporting the sites where the research is happening, to manage the clinical trials in more efficient, more robust way, and this is recognized more and more by sponsors who are contracting with Ergomed clinical research services. Certainly our co-development model is differentiator because we are probably the leading company in this moment globally with this model, having 5 products in development, as you've seen, building up further this pipeline. And there are obviously trials to do something similar like us, but we are quite long in this model. There were some companies and some of the major or biggest CROs who been in this model, who divested this model, sold it out for a huge amount of capital. And in this moment in time, we believe that we are really the leading party with most experience with this model. Certainly this is also differentiator where we attract service business, but also we secure some co-development revenue and deals. I think this is more or less, in the context of this question.
Yep, thank you, very comprehensive. Just a factual question on PharmInvent. Can you clarify that the earnouts that are due or will become due are payable in cash, not shares? And were the original shares that were part of the consideration to the owners locked up for any period of time?
So the initial consideration and the earnout is payable in cash and shares in the ratio 80%, 20%.
80% cash.
80% cash, 20% shares. And yes, the initial shares were locked up for a period of 1 year with orderly marketing provisions thereafter.
Okay, thank you. Question for you, Andrew, from Richie. Are you confident of achieving 2 co-development deals per annum? And as you've already said, it is a question of doing the right deals. So do you really need a top-down target like that to work to?
Well, we try and be very selective on the partnerships which we consider. My objective is to get 2 deals per year. We have initial assessments of over 100 molecules every year. We then triage that down to probably 50 compounds that we exchange confidential information on and have a deeper dive. And I probably have, at the moment, 15 discussions with ongoing potential partners. So I'm very optimistic of reaching 2 co-development deals this year, but they have to be the right ones. They have to be the right deal structures that compel the Ergomed board to give me their endorsement. So I'm working with that objective and with that intention.
Okay, thank you. Then perhaps follow up in terms of licensing deals. Nigel says, pardon his ignorance, not being an expert in the sector, but looking at the hemostatics products, would it always be the case that you would, or other parties would wait for phase 2 results in a situation like Peprostat, or is there the possibility, however remote, of licensing deals before phase 2 results?
Okay. Well, obviously, the later in development, the more data you have, the higher value you can command for the licensing deal. And that was really the issue for the hemostatics when they were a private company. They were engaged with a number of partnering discussions before we bought them, but because they didn't have phase 2 data, they weren't able to get enough of an upfront payment that made the deal workable for them. Now that we've actually initiated the phase 2 study, we have a lot of partners who were standing on the sidelines, not really wanting to engage with us. But now that they see the programs going forward and we will have phase 2 data within the next year, they now want to start re-engaging with us. So a number of potential parties are reinvigorated into these discussions. But products are partnered at all stages in development, both preclinical, clinical, and post-marketing in our industry. And it's all about getting the right deal with the right partner at the right time. So it's possible we might deal on the products earlier, as long as we think we're capturing enough of the long-term upside, or we may hold on to the products longer, develop more data, and enter into partnerships later. I guess the one thing that we're clear about is Ergomed does not have an ambition to become a marketing organization or take these products to market ourselves. We do want to find a partner at some stage.
Fully understood, thank you. A couple of questions for you, Stephen. Just on the possible bad debt, so could you clarify, is the 0.9 million, does that represent the whole outstanding sum or part of it? And presumably that was a CRO customer, asks Frank.
It does not represent the whole. It represents everything that they're not paying us. And it does represent a CRO customer, yes.
Okay, then a question on gross margins. As PV is growing so rapidly, how much further do you, or if you don't want to make forecasts, other commentators think that gross margins could rise, obviously ignoring the impact of any future deals that might be done on the investment side?
So there are 2 parts to two sides to the pharmacovigilance business. One is sort of consulting with high intellectual input side of the business, and the other side of the business is, I wouldn't say it's not intellectual input, but it's more based around case processing. The case processing component of the business is largely people dependent, so more cases need more people, and therefore there is a limit to which you can squeeze out margin. So I think we can make incremental improvements, but not giant leaps.
Okay, thank you. Perhaps for Miro or any of you, acquisitions, and in your statement you refer to preferring targets in the service area that is growing very nicely at the moment. But if you were in a position of choice, which regions would you like to develop the business most in? Would you, for instance, like to buy in America after all the deals that you've done in the Eurozone recently?
Thank you. Certainly we are looking and have wished to expand further our business in America. We have ongoing CRO, clinical research service business in America. We want to strengthen it, and probably we are doing it in organic and probably in some kind of acquisition mode. as well as we find it quite important to extend further and faster our pharmacovigilance presence in America, and we are also looking for some potential acquisitions in this context. On the other side, we are obviously very open toward Asia, which is coming as very important market in clinical research over the last 5+ years. And after establishing our initial office in Taipei, we are looking how to expand further that business, and that might include also some acquisitions.
Thank you. Then the last couple of questions come from James. You do have quite a unique business model, so who do you think investors might look at as quoted comparables within the sector? And then after that, as things seem to be going quite well, what would you regard as the biggest risks that you might face in the next year or so?
Okay, regarding quoted companies, I think very good comparator is a very successful German company called Evotec, which is listed in Germany but has also big facilities in the UK and all around the world, and they are a drug discovery company, in fact, who are doing service business very successfully and growing it very successfully over the last period, as well as invest in some of their discoveries and advancing this product pipeline toward clinic. So their market cap really and market share price increased really very nicely over the last 2 years, and this is quite similar model to Ergomed, but in different area, in preclinical and discovery one. Yeah, there is in Europe one fantastic success which came out of hybrid business model, preclinical discovery and services and product development, which is Galapagos in Netherlands, which has a market cap over about 2 billion, so 2.5 billion euros. Evotec is about billion. And also there is a company in Italy, in Milan, which is under the radar, at least in the UK, but this is fantastic success which happened over the last 10 years, which is kind of combination of pharmaceutical manufacturing and development of products and using some of proceeds and profit of this manufacturing to develop their own product platform. And this company made fantastic success and is listed on Zurich Stock Exchange, or Cosmo, and has a market cap, I think, over 2 billions in this moment. So these are kind of similar hybrid models. There were some in the US before with very successful exits. So we believe that with this model we really allow fantastic downside protection for investors, because as you've seen, our service is growing, not last year, this is growing since we've done IPO, and before IPO we delivered all our targets and exceeded these targets. And obviously with this growth, the value of service business is growing significantly over the next couple of years, and this is that last slide what we presented. On the other side, with successes in the co-development and getting some milestones around that, and around proprietary products, including licensing deals and further commercialization, we believe that we create really fantastic platform for shareholder value increase. Yeah.
Good. And what things might worry you every night when you go to bed, Miro? Or is there nothing in you sleep very well?
No, I try to sleep well. In spite we developed a sleeping tablet, as you've seen, but we've been successful with that, having good results. You see, obviously, any service business creates worries. That the BD environment might become very difficult. That you get termination of some large contract. That you lose some big client and stuff like that. But we've been able to manage the business for many years. We are 20 years in business. We've been always profitable. We've been growing the business, internationalizing us. internationalizing the business, and we found solution in the most difficult time, and it was a crisis in 2009 to 12, So, I'm very optimistic, but, there is always some risk in business, obviously, associated with BD and cancellation, stuff like that, which doesn't happen really often.